Hello, good morning. What is up, everyone? I hope you're doing well. It is, what is it? March 26th. It's Wednesday, middle of the week, hump day as we like to call it. And there is some news that's going on right now pre market. We're going to talk about these equities in this equity space with this new and potentially revived little bull bounce, right? As we've talked about it before, there are criteria that I'd like to see for that expansion to continue, and that's going to be one of the big topics for this morning update, specifically surrounding the S&P 500. But first, let's take a look at some of the information, some of the news that's coming out. Right, Moody's is sounding the alarm bell again on the U.S. fiscal picture. The agency had already downgraded America's top credit rating along with Fitch following a debt ceiling battle on Capitol Hill in 2023, while the S&P Global Ratings was the first to strip the U.S. government of its AAA score in 2011. The latest from Moody's comes ahead of new estimates by the Congressional Budget Office, which will detail the government's long-term economic budget outlook on Thursday. And the evolving U.S. government policy agenda on trade, immigration, taxes, federal spending, and regulations could reshape parts of the U.S. and global economy with significant long-term consequences, what Moody declared. Fiscal strength is on course for a continued multi-year decline, and there are increasing risks that deterioration in the U.S. fiscal strength may no longer be fully offset by its extraordinary economic strength. In fact, fiscal weakness will likely persist even in a favorable economic and financial scenario. So, a very interesting kind of breakdown from that. Credit ratings play a critical role in debt affordability and seek to determine the ability and willingness of a corporation or sovereign government to service their bonds on time. However, there is plenty of criticism of agencies over the past missteps, like their trustworthy ratings for instruments responsible for the financial crisis. And there is also a general lack of transparency or oversight surrounding their actual methodologies and quality credit assessments. While the big rating agencies are rating agencies are paid by the sellers of the securities, they rate companies, and sovereigns don't have much of a choice when it comes to getting their bonds priced and raising debt with big rating firm status enshrined in current regulatory regimes. So Moody's has assigned a negative outlook actually on America's top-notch AAA credit rating since November 2023, which was a controversial decision on Wall Street and came after a similar move by Fitch. The U.S. is the most prosperous and secure nation on the planet and has the best economy in the world. This is what CEO Jamie Dimon said at the time, JP Morgan CEO. There are a bunch of countries that are rated higher than us, like AAA, but they live under the American enterprise military system. It's kind of ridiculous the markets decide, and it's not the rating agencies who make the big decisions. So I guess there is some validity to that. It is continuously sounding some alarm bells as the market continues to kind of inch higher over the last few days. Today we have Fed speaker coming on at 10 a.m. Eastern Time, Fed's Kashkari, and then we have EIA petroleum inventories. We've got survey of business uncertainty, and we have Fed's Musalem speaking in the afternoon at 1:10 p.m. Eastern Time. So breaking down kind of what we got going on in this market on the S&P specifically. Kind of quicker update here, but not really too much to talk about. We're in a position right now where we've rallied, we've gapped up, we've rallied into a new distribution higher. We're sitting in this area between 5,800 and 5,835. Now, we've seen multiple tests of the 5835 top of the distribution with a few failures. We saw that last week at 5760 on the S&P, where ultimately, right, we did get a decline lower. Some of the concerns based on the image and the auction theory right here is the basis of the weak volume, low volume that pretty much sprung the rally to move above 5800. So there is fragility under that area where we can get a decent expansion, about a 40-point drop to the downside from that region. Now, the way that I see it is the buy side has to imperatively hold 5,800 if we do see that pullback, but more so, these multi-tests of 5835 here on the S&P, right, they have to get broken to the upside swing, otherwise the bull loses a lot of momentum realistically. So that's the way I see it. We have a decent balance that's been created between 5800 and 5835 this week, and the expectations are that we hold the bottom band of that for the bull side. But, right, that comes with a caveat. We do have to see the expansion above the tops of the distribution if there's going to be any kind of continuation and continuity in this market to have that kind of pull to the upside swing to continue our momentum, right? There is some fragile momentum that's happening at that 58.35 right now with absorption and sell side trying to hold through. So realistically, we do need to see that climb higher. Otherwise, things can get shaky and we can see a decent pullback on the session. NASDAQ has a slight bit of bullishness with big tech starting to rally a little more aggressively to pull markets up. So that big tech rally, the top 10 names, especially in the S&P, would want to hold a bid to the continuation of the upside to hold these things out, because they've gotten sold off extremely aggressively. We've seen 20 to 30% drops from their highs on the Mag 7s, even more in the case of Tesla. So the key is right now, if that continuation holds true on tech, which NASDAQ is looking a bit more bullish than the S&P, we should start seeing that continuity, because above 58.35, honestly, we do have a significant expectation that prices have like approximately a 50 to 80 point rally on the S&P in their sights. So that's what I'm going to be doing today, right? I do want to sustain the long side as long as 5800 area does hold. It would be interesting to see if we can actually break that 58.35. If we just break 58.35 off the open, fantastic work. Like, let them just run it through and we can start looking for dips to buy into. So caution around 58.35 on the S&P. That's what I'll leave you guys with. Remember to check out community.tradeproacademy.com, and I'll see you guys tomorrow. So happy trading midweek, right? We got a few Fed speakers today. Let's not get crazy with it, and I'll see you guys tomorrow. Thank you and take care.